Hi, I'm Pattu from Frequent Cal. Equity savings funds, which the AMCs recommend for short term investments, suffered huge losses in this market crash. And let's take a look at how they fell and why even a small amount of equity in your portfolio for short term goals can severely cause problems in terms of losses. So, what you see here is a Mirae Asset Savings Fund. This fell by a huge amount, about 18% or so, and in comparison is the Nifty 50 arbitrage index. So in the arbitrage funds over 32 day period between February 20th to March 23rd have gone up by about 0.5%, or more or less they've been stable. Whereas equity savings fund, which is recommended for regular income and short-term goals, I'll show you some numbers, have fallen by a big amount. Now, in 2014, when the long-term capital gains tax duration for debt funds were increased from 1 year to 3 years, AMCs figured that people will not invest in fixed maturity plans, fixed FMP plans, and they invented a new category which I then called a Chinese dosa, which was a mixing of unnecessary things. And they invented a category called the equity savings fund, where they created a equity-like fund, but they wanted it to be more or less like a increase, like the NAV should increase like a debt fund. So they mixed arbitrage and debt funds. That was the original intention. But then gradually they started increasing the direct equity or the unhedged equity exposure into equity savings fund, and they became more and more volatile. And I have actually pointed it out multiple times in the past that you should not use it for short-term goals, and at least definitely not for less than 5 years. If you go to the AMC pages, Mirae says you can use it for 1 to 3 years. They call it the ideal investment horizon for this, which is crazy. HDFC says 1.5 to 2 years, 18 to 24 months. Franklin says 1 year and above. Kotak and ICICI are at least a little bit better. They say 3 years and above. And that's really crazy. And if you look at how much they fell between February 20th to March 23rd, you can see Nippon India equity savings fell the most by minus 24%. In fact, when it was Reliance Savings Fund, they held Reliance Capital, and that bond defaulted, and there is actually a segregated portfolio for Nippon India Savings Fund. Then you have other funds which have fallen minus 20%, 19%, 18%, and so on. Only two funds, Edelweiss fell by 9.5% and Baroda by 8.3%. Those are the only ones which fell the least. And these are funds which are recommended for regular income and for short-term goals, which is just crazy. If you have invested in this for 1 year, 2 year, 3 years, you would have lost money forever. You can never make this up if you are in for the short term. Of course, you can say market will come back quickly and everything will be all right and so on. But then that's not a guarantee, right? I mean, you can't invest with such things in mind, and definitely for the short term, it's bizarre. The SEBI categorization rule only says that the minimum investment in equity and equity related investment should be 65%, debt is 10%, the hedged equity and unhedged equity should be stated in the scheme document. They do not have any kind of rules of how much unhedged equity, that is direct stock exposure, should be there in this category, and they can have any amount, including even 65% they can have, and that's just crazy for a category. So there's no real categorization and regulation at the category level, and that is the reason why I think there's so much of loss, because people, fund managers, instead of making it a pure arbitrage come bond fund, they take on direct equity and cause all these kind of problems. This is bizarre. And if you look at the window that I just told you, between February 20th to March 23rd, on average the category fell about 16%. And a hybrid index with just 25% equity fell 11%, and a hybrid index with 65% equity fell 25%. This means that on average, equity savings funds typically at the time of the crash held somewhere between 30 to 40% equity. 30 to 40% equity has led to 16%, 17%, 18% falls, and in the portfolio, and that's very, very dangerous for the short term. If anything, there are only two lessons: stay away from all equity savings funds. They're too difficult. Most people don't understand the risk involved. They go by that savings word, which is absolute garbage that has to be removed. They should not be allowed to have so much equity and say they are going to use it for regular income, and they should not be, if they are going to hold so much equity, they should not be recommending it for the short term. So these are things that SEBI should take care, and AMCs themselves should realize and change the product. This is just too much of a fall for a fund with the name equity savings in it, for the words equity savings in it. And equity savings, it's shown because of this fall that it is a pretty much an oxymoron. So that's what I wanted to say in this video. I'll catch you again later. Bye bye.